Greg, thanks for having me over. I love doing this. I've been doing this with ICG Next for a few years now, every November. And November is considered Long-Term Care Awareness Month by the industry. So you might see a lot of marketing stuff around nursing homes, agencies, anything that's related to long-term care in the market as well. But I'm specifically here just to talk about how the industry has changed, right? So what we're going to address today is the genesis of long-term care insurance and how it's changed over the years and who should really be considering this, right? Like, well, not everyone not everyone has a right fit for this type of a product as well, but we're just going to talk through differences and what you should be looking at considering so you can have an educated conversation with your advisor when the time is right. But also, I'm hoping that at the end of the call that everyone stops being shy and would share with me what their favorite pie is going to be in the next 2 weeks, right? Because it's Pie Day. All right. So when it comes to long-term care as such, right now, insurance is a very important topic, but when it comes to long-term care specifically, it's about living too long, right? Like we all talk about it from a financial planning aspect. If you're running a financial plan with your financial advisor, they probably always talk about, look, we're worried, we want to make sure that your assets last your lifetime and then your legacy plan is fulfilled, right? So what long-term care really is from an industry language is if you need assistance, right? Any kind of help with two activities of daily living, right? So those are the activities that help us be independent, right? So that's the basic activities. If we need help or if there's cognitive decline, and if you need assistance for more than 90 days, that becomes a long-term care event. So it's not a place that you go to, or it's not an old age home that you go to, or a nursing home or a facility. It's when you need assistance, and you could stay at home, you could be recovering from a surgery, it could be any of that. That's the definition of long-term care. If you need assistance for more than 90 days, that is a long-term care event, right? Typically, for a long-term care event, there's a cost associated to it, right? Even if you were to stay at home and if you needed any type of assistance, even if a family member is taking care of you, there is a cost associated with it. And fast forward, if you needed care in a nursing home facility or an assisted living facility, there's a cost associated with it too. And it's different in different states, in different areas, in the type of care setting that you receive. Now, there are two models when you talk about funding long-term care, right? You have the traditional long-term care insurance model. It's just like your home insurance, your car insurance. You're saying, look, if I want to cover the risk of my home being destroyed, I buy home insurance, right? Life insurance, if you need it like to cover death, you have term life insurance. The traditional long-term care insurance model covers for long-term care costs. These were rampant, say 25 years, 30 years ago. We have fewer and fewer providers in the market today that provides this type of insurance in the market. Now, fast forward now, we have the hybrid long-term care model, which is saying that, you know what, it is a very expensive risk to cover. How about we add solutions in the marketplace that can give you different options and flexibility that you can use when you need to, right? So again, going back to what long-term care is, right? So let's look at a statistic. We have a good number of people in this Zoom room today. So it says the statistic of 56% of the US population turning 65 years old today will need some type of assistance during their lifetime. So now the question becomes, it's not a what if it happens to me. The question is, when is it going to happen, right? Because what that number really tells you is that one out of two of every people in this room today, we will need some type of assistance during our lifetime. Right now, the activities of daily living. So if we need help with 2 out of the 6 activities of daily living, so these are basic, right? The number one reason that someone goes on claim for long-term care and needs assistance with any two, it's from a fall around age 83 to 85 or so. That's the statistic. That's what I hear. right? And what are the popular care services? We start off at home, you receive care at home, you go into an adult daycare, and then you go into a nursing facility or an assisted living facility. These are the popular care services that most people start off needing care at home, and then they progress to a stage wherein they might need a nursing home stay or may not even need a nursing home stay. You stay at home while you need care. So, what really pays for care, right? There's a lot of myths surrounding it. So, let's break it down, right? What pays for care? What does Medicare do? What does Medicaid do? So, Medicare is a health supplement, right? So, it's something that you would plan to use once you reach the age, and it's a supplement. It provides care for skilled health care, right? So, and it has limits on what it pays for. So, example again, if you have a stroke and you're recovering in a hospital, the hospital stay is covered by Medicare up to 90 days, right? So, that's what Medicare really covers. So, what does Medicaid do? Medicaid is government assistance for long term care. However, the government requires you to deplete all of your assets. In the state of New Jersey, that's up to $2,000 of the assets for you to be eligible to Medicaid. And the government would decide which facility you'd be able to go to if you needed extended care. So those are the two government programs that's available. So another popular option is, and the default option for most people is self-funding their own care. So if you don't have some type of long-term care insurance today, what are you really doing? You're growing your assets, you're saving money for whatever reason, but if you needed care, your assets are subject to providing for that care. That's self-funding your own care, right? Another option, again, that's default is family, right? I don't know about most people, but most, like I'm not fortunate enough to live near my family. My family is very, very far away. They're in India, right? More and more people, we have family members living far away from us, and it's harder and harder to rely on family for care, say 20, 25 years later. Then we move on to the transference of risk, right? So if we don't want to self-fund, or if it's not the best way to do it, we don't want the government telling us which facility we can go to and we have no say. What if it's in, like, where we live in New Jersey and they're like, oh, the only available place is in Pennsylvania, right? So that's another option too. So then you say, okay, fine, let's look at insurance. How do we transfer that risk to insurance? What can insurance do for me? You have the traditional long-term care insurance model and the hybrid long-term care insurance model. So let's break down the traditional long-term care model. So let's see, we see this two stop, right? So it's a road, we go in, and if you want to say, okay, what does long-term care insurance do for me, right? If there's a long-term care event, you've bought a policy, it pays for long-term care benefits if you need it. So if you need assistance with 2 out of the 6 activities of daily living, this policy will tell you your benefit is, say, $300 a day, you can use it. But if you never use it for the long-term care benefits and God forbid you pass away, what happens? There is no benefit, right? So this type of model it's a use it or lose it policy. You use it for long-term care. If you don't use it, the premiums that you've paid, it's a sunk cost, right? Now there's no problem with it because it serves a purpose. However, because of that statistic where 1 out of 2 people turning 65 years old today will need care, it becomes a very expensive model. So if you were to go and buy the traditional long-term care insurance where premiums keep going up, or you pay premiums for the next 20, 25, 30 years, it could become a very expensive proposition. So some people say, you know what, I don't like it. I'm not going to buy it. So I'm going to default to my default strategy, which is self-funding my own care. Right? So what does a hybrid long-term care solution does? Like Brighthouse, I work with Brighthouse Financial. I should have introduced myself beforehand. My name is Reya Simon. I work with Brighthouse Financial and I work with ICG Next, right? So what does Brighthouse really do? It is a hybrid long-term care product that provides different accesses, right? So if you needed a long-term care insurance, it has a long-term care bucket. If you never use it, You have access to it, access to your money in the form of a death benefit, and your long-term care benefit is going to grow over time too. So what does it really do? Let's look at it as a roundabout, right? And I have to say that one of the roundabouts that I always I hit no matter what is when I go to ICG next, the office in Wall, because there's a really big roundabout there, right? So let's say this is the roundabout of life, okay? And you keep going and you say you take one turn, you needed long-term care, you have the access to the long-term care bucket. But what if you don't need long-term care and you pass away? I call it family money. The money that goes in goes to your family members as a death benefit. And if you still change your mind and say, you know what, I'm 97 years old, I don't see long-term care, I want to go on a cruise, we have something known as a cash value that you can walk away with. So your money is accessible in one of three ways all of the time, right? You have access to the long-term care bucket. If you never use it, there's going to be a death benefit. And still, if you change your mind, you can walk away with a cash value. That's what a hybrid life insurance and long-term care policy does. It gives you exit options. Right now, the biggest benefit that you have within a hybrid model is the long-term care benefit. And I know we have a number of people on this call, so we have different ages, different sections, but just for you to get an idea about the numbers, right? Say if you're 60 years old, and if you have $1 that you put into Brighthouse Smart Care, what do these three buckets look like? The long-term care bucket is going to be $4, right? That's accessible to you. So that's a big bucket that's accessible. With a hybrid long-term care product, the long-term care bucket is always tax-free. So $4 is available for you tax-free if you needed long-term care. Again, what if you pass away and you don't use it and you turn this way, right? So if that's the case, your family would get what you put in, which is your $1 plus a bit more. So they would probably get about $1.5 back over a period of time as a benefit. Now, still, you've changed your mind. You want to walk away with a cash value, and that's the route you want to take. We guarantee that we will give you like 75 cents. So 75% of what you've put in comes back to you. That's what's guaranteed that you'd get back. So what you've essentially done is you've paid 25% to get access to a high long-term care benefit if you need it. So that's where leverage and tax efficiency comes in, right? So that's where that protection really steps in. So I'm going to pause here, and I know I went through this really quick. But from a hybrid standpoint, what we really see is people have a lot of questions, right? Saying that who can qualify for this type of product? Who should be considering this? So I'm going to pause here, take some questions, and then see where you want to take this forward from here as well.
Questions? Anyone got questions? Well, I'll kick one off. Tell me that, obviously as we get older, our medical history is a little bit more complicated. So tell us about the underwriting process. How difficult is it to get protection? And what questions, are there some factors, or if you're on certain medications where it's like it doesn't even make sense to go through the process? Yeah. Tell us a little bit about that underwriting process.
So when we talk about insurance companies providing long-term care insurance, right? Again, with long-term care, we're always talking about living too long. But insurance companies, what they're scared about is if you live too long with a chronic illness and you need assistance, right? So we want to take on as many healthy people as possible. So what does that look like from a long-term care standpoint is if you're in chronic pain, that's a red flag for long-term care, right? So it says if you're in chronic back pain, or, like if you've needed hip surgeries and you're overweight, or if you're a smoker and you have cancer, the combination of multiple issues are always a red flag for long-term care. That being said, from an underwriting perspective, if you wanted to buy this, hybrid long-term care products don't require you to go for a physical, because as an insurance company, we rely on the medical databases so we can see your history. So we look at 10 years of medical history to see if you're a good candidate for a product like this, right? So the popular ones that we see that we cannot underwrite for, and it's most common, is insulin-dependent diabetes. That's something that we don't write for from a long-term care standpoint. Both the hybrid as well as the traditional long-term care insurance, that would be a no-go. Cancers of the major organs, that's going to be out as well, right? Another one is stroke. If you've had a stroke in the past, even if you're fine now, but you've had a stroke within the past 10 years, we wouldn't be able to write you, right? So those are some of the major ones that we see. And another one that mostly people don't think about it, but if you've had 3 DUIs or more, you wouldn't be eligible either for long-term care. Does that answer your question, Craig?
Yep, absolutely.
Great.
When should a person, what's a good age? I mean, because obviously, younger folks, and then at what age is kind of like the sweet spot when you look at the types of individuals that you're writing? What is the age band that they're typically falling into?
So people who buy this, right, they're going to be between 60 to 75 years of age. That's where we get most interest from. And it's mostly because they've had a personal experience in their family, or they've heard, like they've known someone who's gone through a long-term care event and they know what the cost associated with it is. Recently, we've been seeing younger people buy this, like age 55-ish or so, just because, we're seeing as a market, we're seeing people inheriting IRAs, right? So people are using to fund this because from a hybrid standpoint, yes, you can fund it as a single premium, but you can also fund it over time. You can pay over 5 years or 10 years to access leverage in long-term care. So if you're 50 years old or 55 years old and you want to say, hey, I don't want to put in $100,000, but I'm good with putting $5,000, $7,000, or $10,000 a year for 10 years, that's a good way to create leverage too. Because again, you're planning for an event that's probably 30, 35 years later. So you don't want to put in a lump sum. You have the option of spreading that amount out.
So yeah, so what are the more common funding mechanisms for long-term care with these policies?
So for that age group, right, for between say 65 to 75, we see a lot of existing life insurance policies that they have. They can do an exchange under the IRS code. It's called a 1035 exchange under that code, wherein you don't have any tax liabilities. You can use the cash value and exchange it into this product, so you get a living benefit on the long-term care benefit, and you still retain some of the death benefit. So where we really see that is if you've bought old whole life policies or universal life policies, you've built up cash value in it. Just as an example, say you have a cash value of $70,000 and the death benefit is $150,000. And you're like, you know what, my kids have grown. I don't really need that death benefit anymore. Is there something else we can do with it? We do the 1035 exchange. So you're buying a long-term care policy with $70,000, and you're creating leverage for long-term care dollars of about 4 times. So you get about $280,000 in long-term care. And if you never needed, the death benefit's still going to be there. It's going to be about $90,000. That's what we see quite a bit too.
Questions other than me? Any other questions from folks out there? Want to raise your hand or type one up? No. When you think about, so obviously when we look at long-term care, and in talking with clients over the years, obviously most people don't want to go to a facility. The number one thing that I hear from individuals is I want to be at home, in my own comforts, and I want people around me who I know to help care, maybe some professionals coming in. What are you seeing in the industry? What's the most common, methods of payment? Who's typically being paid? I've heard commercials where people are saying, you know, they're paying their nieces and nephews for providing care for them.
Yeah.
It, put some thought around how is the disbursements being utilized in today's world? Because, you know, over the last 20 years, you know, it was kind of the thought of, well, if I buy long-term care, I'm like buying a ticket to a nursing home, and that's the last place I want to be. So I really don't want to do that. And is that still the case, or is the dynamics changed?
That's a really good question. And I think that's one of the biggest differences among the traditional model and today's hybrid models of long-term care insurance. Because traditionally, long-term care insurance policies always paid the benefit out as a reimbursement. What that means to you is if you needed to use your policy, you would pay for services out of pocket, collect the receipts, send it to the insurance company, and they would reimburse you for verified costs. So, for all of the care that you've received by family members, or if you've hired someone informally, if you don't have a receipt, you're not going to get reimbursed for it, right? Now, statistically, most people, when they start needing care, they stay at home and their loved ones care for them. It's universally true all across the world, right? The loved ones take care of them until they cannot anymore. And then they move into a nursing home where they're there for a year and a half, maybe 2 years, right? And that's end of life. So that's that. So traditionally, reimbursement policies would only typically pay out for that end of life care in a nursing home. Now, the newer products where like Brighthouse and the hybrid products, we have something known as a cash payout. And in the industry, we call it cash indemnity benefit. What that does is they wait for 90 days because Medicare typically takes care of the skilled care that you need for the first 90 days. And on the 91st day, we write the check. We don't require proof of receipts. We don't require any of that to show who's taking care of you. We just pay that dollar amount out and you can use it the way you want to use it. So it hits your account every single month when you need it. Right? So
Now,
it's called the cash benefit.
so to trigger that, you just need a doctor signing off that you need assistance in two of the ADRs that are out there?
Yes.
ADLs?
Yes. So every time we go to a physician for an annual physical, your doctor is going to assess you on how independent you are. So they're going to write you. If you've ever seen your doctor's records, they're going to write you can perform 6 out of 6 ADLs. That's the language that they use. So, you know, if you need assistance with 2 out of those 6, or you have cognitive decline because of Alzheimer's or dementia, you can trigger the long-term care benefit.
Now, did you mention earlier that you could put qualified or IRA money or pay IRA money? What was the
Inherited?
or
So you wouldn't be able to do like qualified assets into this, but what you can do is if you've inherited IRAs, right? So with the beneficiary IRAs, you have to take distributions out within the next 10 years.
okay.
So then you can use those distributions and say, let's create leverage in a long-term care product. So that's where we see the younger folk really buy it, say in their 40s and 50s buy it, wherein at least until 5 years back, we only saw people between 60 to 75 buy it.
Got it. Got it. All righty. Other questions or thoughts in regards to long-term care?
If you don't want to speak on the question, you can use this little chat button box at the bottom of the Zoom too. If you want to just type out any questions you may have, or if you want to share anything that you've gone through from a long-term care standpoint, that I'm happy to answer that as well.
Well, the answer to is apple pie. I prefer
Apple pie.
apple pie.
Well,
How do you want to pay for your elder care expenses? If you don't do anything, the default is you're responsible for 100% of the bill. And if you're okay with that and you've got enough money, no reason to consider anything else, or at least you don't have to consider it. But if you don't want to pay for 100% of the bill, then you have some opportunities. I know with some annuities, they create some leveraging opportunities, but you also do have hybrid life insurance that can create a multiple benefit, whether it be life insurance or whether it's a stream of income that can be used to help offset those cares. Leveraging dollars is kind of the key to the kingdom, where you're not paying the entire cost with a bill. You know, what people never liked about long-term care, the traditional, well, the question would always be, well, Craig, what happens if I don't use it? I'm like, well, I guess you're one of the blessed ones, because then you didn't have to, you didn't have to deal with elder care issues or going into a facility. But from a money perspective, you don't use it, you lose the premium. Here is a scenario where you don't lose the premium. You have the option through a hybrid where you can park money into a vehicle. It can create that leverage for the long-term care. If you're one of the blessed ones that never need to use it, then the assets would then pass to the next generation tax-free in the life insurance policy. It's a way of trying to create that hybrid opportunity to meet this increasing challenge and demand of how are we going to deal with the elder care expense, because one of the benefits or one of the challenges with longevity is how do you pay for it? How do you afford it? And so these are the creative ways that many of the insurance companies are trying to address this need so that the clients can be protected, the insurance companies can be protected, and more importantly, you could have the professional care that you need in that later phase of your life, in making sure that you got proper care and you can afford to make those payments. So as a clients, what I would suggest, if you haven't talked to your advisor about what your strategy is, I would encourage you, put it on your agenda for 2025 to come up with a strategy on how do you want to address those elder care expenses. Because as an advisor, what typically happens when something happens, one of your heirs typically calls someone like myself and say, well, what's the game plan? And you got to have a game plan. And doing nothing means the game plan is we start with the checking account, we go to the savings account, we go to the non-qualified investment account, we go to the qualified account, and then after those things are depleted, then we talk to Medicaid. Not saying that's the wrong strategy, that is a strategy. It doesn't have to be your strategy. I would sit down with your advisor, have that conversation to determine how you want it to be, because there are vehicles that are out there that will allow you not to pay for all of it, maybe pay for some of it. And if you choose to, you could create a strategy where you don't have to pay for any of it and let insurance carriers take that risk off your plate. There's no right answer. There's no wrong answer. You just need to create your answer so that we can guide your beneficiaries, your heirs, on what your wishes are to address this expense down the road. Because it is a real life expense that as a professional we deal with on a very frequent basis of making sure that we're paying the appropriate care to make sure that you're comfortable in those final phases of life. So with that, Reya, any last comments or thoughts in regards to before we wrap things up?
So the only thing I would again add to Craig, right? Like even if you've had this conversation before with your advisor or with anyone in the past, right? I would review that again with your advisor, right? Because products keep changing. There are new solutions in the marketplace all of the time. Your situation might have changed, right? So one of the big things when it comes to any type of insurance, it's really your health, right? So it's insurability at the end of the day, because that can change at the drop of a hat. And when we see that all of the time, and Craig, you might see that all of the time too, when people ask, say, hey, I want to think about long-term care. I was diagnosed with this. Would I be able to buy something? Unfortunately not, right? So that's the big thing about insurability. And as you get older, insurance also becomes more expensive. So if you ask me what the right time is to have that conversation, it's like when you review your financial plans with your advisor, just ask, hey, is long-term care something I should be considering based on my asset level, based on the growth that we have, and your advisor would be able to steer you in the right direction.
I agree. I agree. Well, Reya, thank you so much for taking time out of your busy day to provide some education for the entire group here at ICG Next. We really do appreciate our partnership. As always, Deb, thank you once again for helping organize everything. And most importantly, I really want to thank all of our clients. This is the last Zoom presentation for this year. I can't believe we're coming to the end of 2024. It just seemed like we were just dealing with Y2K yesterday, and now we're now in the roaring 20s again. 2025 is just around the corner. On behalf of our clients, I want to thank you for being clients. You know, it's easy to be our clients in the good years, but I want to say thank you for hanging in with us during all the lean years. We had a few down years over the last couple of years, and we do appreciate you hanging in there when things didn't look good. Patience, developing that plan, making sure that we're safeguarding it, utilizing, taking a look in, using a creative eye, and looking at all the various different products and services out there to design the plan that fits your personality, your lifestyle, and your desires is really our goal, and we're continuing to focus in on that. But we do thank you for hanging in during those challenging times. Hopefully 2025 will bring us a nice prosperous year.